Welcome to FinBot Insights, where we break down professional research for you, the retail investor. Today, we're going after a big one, a sacred cow of modern finance. For 30 years, you could have beaten the experts just by betting on America. But what if all that winning was just luck? We're here to challenge the deeply held belief that simply owning U.S. stocks is the only smart move. We're going to dig into why an entire generation of amazing returns might actually be a dangerous trap for your future.
All right, first things first, let's start by acknowledging a plain and simple fact.
Look, for an entire generation, more than 30 years, if you invested outside the U.S., you lost. You underperformed anyone who just stuck with good old American stocks. The numbers don't lie, and they're not even close. And, a winning streak that long creates a powerful story, doesn't it? It's built this whole cottage industry of people explaining why this time is different and why the old rules just don't apply anymore. The narrative is that America is just exceptional and diversifying is for suckers. And honestly, it's become really hard to argue with. So to figure out what happens next, we have to really understand what happened before. Let's perform an anatomy of this victory and deconstruct exactly where all that outperformance came from. Okay, let's start with the headline number because it is absolutely staggering. Since 1990, U.S. equities have beaten their developed market peers by 4.6% every single year on average. That is a massive, massive gap. But here's the billion-dollar question, or maybe trillion-dollar question. Why? Was this victory driven by American companies being fundamentally better, or was it driven by investors just being willing to pay a higher and higher price for them? The answer to that question changes everything. It tells us if the past is a roadmap or a trap. Think about it this way. There are really only two ways to win. Path one is fundamental growth. Your companies are just better. They earn more money. They pay more dividends. That kind of advantage could theoretically last. Path two is what we call valuation richening. This is where investors just decide to pay more for the same dollar of earnings. The company isn't better, the stock price is just higher. And that's a party that can't go on forever. So how do we tell the difference? Well, we need a tool. For this, we're going to use the Shiller-Cape ratio. Now, all you need to know is that it's a really solid long-term way to measure if a market is cheap or expensive compared to its actual historical earnings. And when we apply this tool, the data is just whoa. It's startling. Back in 1990, U.S. stocks were actually cheap compared to the rest of the world. Their valuation was about half of international stocks. But fast forward to today, and that has completely flipped. U.S. valuations are now 1.5 times higher. The price tag for U.S. stocks relative to the world has literally tripled. So what happens when we adjust for that? When we mathematically remove the effect of the U.S. market just getting more and more expensive? Well, that massive 4.6% annual victory, it pretty much vanishes. It shrinks all the way down to just 1.2%, a number so small it's statistically meaningless. Let that sink in. The story of the last 30 years wasn't one of fundamental American superiority. It was a story of repricing. The win didn't come from American companies being wildly better. It came from investors being willing to pay wildly more for them. Okay, so this brings us to the biggest argument you always hear against diversifying, the crash myth, the classic line, everything goes down together, so why even bother? And there's a kernel of truth here. The argument is that when things get really bad, when there's a big crash, correlations spike, everything sells off together. So in that moment of panic, your international stocks don't save you. But this argument misses the bigger picture entirely. It confuses two totally different kinds of pain. There's this short-term pain of a sudden crash where, yes, everything goes down. But then there's the long-term pain, the real wealth killer, of a lost decade. And that's a completely different animal. Just look at Japan. Their market boomed and then went into a multi-decade bust, a path that was completely different from the rest of the world. Yes, markets crash together, but their long-term recoveries and economic cycles can be worlds apart. That is what diversification protects you from. Not the flash crash, but the permanent destruction of capital. And all of this leads us to a really dangerous bet. Let's look at why taking the last 30 years of history and just pasting it onto the future might lead you straight to ruin. Right now, as we speak, that valuation gap between the US and the rest of the world is stretched to a historical extreme. You are paying a massive premium for US stocks compared to what you'd pay for international ones. It's about as wide as it's ever been.
And here is the ultimate irony. The very thing that made the US market a winner for 30 years, getting more expensive, is the single biggest warning sign for its future. As the saying goes, don't get excited if a country wins just because it got more expensive. Because valuations, especially when they're at extreme levels like this, have a nasty habit of reverting to the mean. What was a tailwind is now a headwind. So, how does a professional investor think about this? How do they play it? Well, the mindset is captured in a simple phrase: no pain, no premium.
Here's the hard truth about diversification. It's almost designed to make you feel like you're making a mistake. A truly diversified portfolio will always have something in it that's underperforming. And looking back, it's easy to think, man, I should have just owned the winner. It takes real discipline to stick with it.
But as a professional investor, that is the job. You have to endure the pain of owning something that's out of favor to earn the long-term premium. No pain, no premium. Sticking with a sound strategy when it's unpopular is the very definition of discipline, and it's what separates successful long-term investors from the crowd.
Which brings us to the final point. Today is a uniquely terrible time to learn the wrong lesson from the past. Given where valuations are right now, abandoning international diversification isn't a bet on American greatness. It's a bet that the US market can get even more expensive from an already extreme starting point. It's a bet that a 30-year repricing event can happen all over again. And that is a very, very low probability bet. Okay, before we wrap up, the important stuff. Please remember, this is for informational purposes only. It is absolutely not financial advice. And frankly, you shouldn't be trusting financial advice from social media influencers, and that includes us. You have to do your own homework and conduct your own independent research. But if you did find this breakdown valuable and it made you think, we'd really appreciate it if you'd like this explainer and subscribe to Finbot Insights for more content like this.